Good evening, everyone. My name is Simon Mishevich. I'm one of the founding members of the Property Expert Panel. It is the first month of February 2021. Yes, we have survived coronavirus for another month, so that must be a good sign, if anything else, this month. So I'm pretty delighted by that. So welcome one and all to tonight's show. As ever, we'll be going through the panel members to introduce themselves to you, good self. And, well, actually, why not get started with that now? So, as Bronwyn Vernicum is still in Namibia, we can't introduce her. So I shall do that a little later on of who she is and how she can help you during your property investment journey. But let's go to one of the other ladies, Paul Hilliard. No, sorry. Let's go to Teresa first. Would you mind doing the introduction, please?
Oh, you are funny, Simon. Yes, hello everybody. I am Teresa Kaczmarek. I'm here representing the National Residential Landlord Association. So the association is set up for landlords. I think we've got about nearly 80,000 landlords registered with us, all with the aim to make their life easier and to give landlords a voice as well within government, because there's plenty of legislation coming out, and we're here to give a voice to landlords. Making it easy for you, well, we've got like template documents, forms online. For example, we've got tenancy agreements online, and you might think, well, I'll just use the government's tenancy agreement or an agent's tenancy agreement. Well, the government's tenancy agreement is about 55 pages long. It covers every possible scenario known to man. So by coming to the NRLA, you can choose a bespoke tenancy agreement, which fits your particular criteria. And also, if you're using an agent and they're using their own tenancy agreement, have you read that? Not that anybody really wants to read a tenancy agreement, but you really do need to, and just check, is it legal? Has it got fair terms in it? Things like that. So yeah, so we've got lots of things to make your life easier. We've got also, if you're not webinared out and podcasted out by now, we have lots of webinars, and we have actually just launched a podcast as well. So yeah, that's it from me, and hopefully I can answer some questions this evening.
Great stuff. Let's go on to Paul Hilliard, bless him, for a proper introduction.
Thank you, Simon. Good evening, everyone. I'm Paul Hilliard. I'm based in Solihull in the West Midlands, and I'm a portfolio investor with everything from single lets in flats and houses to HMOs to service accommodation, and I've dabbled in developments on the commercial to residential methods, and that's certainly an exciting time for 2021. So make sure, if you're into investing, consider that. I'm also the operations director for LMPG, which I'm sure everyone knows now are the UK's best and biggest landlord buying group in the UK. And we deal with the likes of Worcester Bosch, Wolseley, Magnet Kitchens, Jewson, Johnson Paints, and thousands more. The aim is to buy, for us to supply you direct from the manufacturers, not through us, but via us, for products which are really quality, made fit for purpose, rather than just buying cheap. And we tend to negotiate directly based on the volumes that we're buying, and therefore you can buy quality products at very low prices. So check us out, and I will pass on to Simon Hodgson.
Right, thanks very much, Paul. Right, yeah, evening, everybody. My name is Simon Hodgson, holder market mortgage broker, directly authorised by the FCA. So, yeah, I started my investing journey back in the early noughties, so that was 2000. I've done all sorts of things since then: title splits, flips, refurbs. Lost it all through the credit crunch, rebuilt it back up since then. And early on in my journey, what I learned was, as I got educated, that very few brokers really understood how an investor wanted to work and how to utilize products that lenders had out there in the correct way. So I ended up telling my then broker what to do, how to do it, and they then charged me for advice, which didn't really seem like a great idea. And that's kind of where I am now. So I invest in properties, typically blocks of flats, but have had HMOs, generally on guaranteed rent schemes, because I don't particularly like managing tenants. They're quite hard work, I find, especially an HMO. Yeah, that's me. So hopefully I can bring all sorts of experience from the financing side here tonight. And I've got some breaking news, hopefully, that we'll be able to go through a little bit later on, which will be quite nice. So I think that probably leads us on to the one and only Tim.
Thank you, Simon. Tim Bishop here from Banana & Bishop. We're an all-service law firm, and we're based in Wiltshire and Hampshire. I've got 4 offices, one of which is Salisbury, the Russian Secret Service's holiday destination of choice. And in terms of the kind of work we do, well, we do all sorts of work, but I've got a property team of 22. It's probably about 40% of our work. And within that, a bit like Simon, I concluded a few years back that a lot of brokers just don't understand investors. And I came to the same conclusion about solicitors. So as a result, we have a specialist property investor team acting for property investors nationwide. That seems to be going pretty well. We have other specialist teams, including our highly specialist lease extension and enfranchisement team, a team of 5. That's all they do. So if you ever want to know about short leases or buying your freehold, we have possibly the largest specialist team of its type in the country. And in addition to the law firm, I'm also an investor and developer. So I've done a commercial version. I've got 6 flats, 4 of which are service accommodation, an 8-bed HMO I converted from a 3-bed. And I'm at the moment sitting on my hands with a view to significantly improving or increasing my portfolio sometime later this year. In addition to the law firm and doing this fantastic event every month, I'm also involved in what we call online speed networking for property investors. And the principle is very simple. We used to go out and meet people at the events, a bit like our event tonight. You could see people, but here, of course, online, you don't meet other people. So we decided to do the complete opposite of Ask the Property Expert. There's no talks and it's pure networking. So if you are interested, let me know. I run it with John Corey of Property Fortress, and it takes place on the 2nd and 4th Wednesday of the month. And also with him, I'm in the process of launching what we call legal masterclasses. The principle is you do need a solicitor, but sometimes if you're going to make the most of risk management and seeing your opportunities, you need to know the right questions to ask. So that's what we're doing with our legal masterclasses, probably a series of about 10 short sessions, which will be live. And we think we're going to trial the first one this Thursday at 11:30, though that's still be confirmed. And that will be all about leasehold reform, lease extension and freehold purchase. But if you're interested, let me know and I'll put you on the mailing list. And apart from that, I think that all of us, apart from the inimitable, I got that word right, Simon from Optimize. Over to Simon Mishewitz.
Thank you and good evening again, one and all. This is a live session, so it's not edited for the faux pas that I make or indeed the insults that I throw to Paul Hilliard. So this is a live session. What I want you to do is ask your questions and we will provide you with the best answers that we can provide. Clearly, if it's about your personal circumstances, especially when it comes to tax, we won't be able to give you that specific, but we can give you some rounded advice, which you can then take forward and get the answers that you need. You can also reach out to the guys that you're seeing in front of you tonight. The descriptions of their contacts will be in the video description. So make sure that you look at that video description as well. And you'll notice I'm looking down, and the reason for that is because I have a mobile phone in front of me, which has got a bunch of questions. So whenever you register in advance, you will be given the opportunity to ask your questions. And that's what I'm looking at. So I'll be asking those questions to the panel members, but of course it's live. So a bit like, I'm just looking at the screen, I've got Stuart, who's also asking the question. So if you are on here tonight and thinking, well, I've not asked my question, don't fear, because you can post that onto the chat function. So we've got Nada now as well asking the same kind of a question. So we'll certainly be answering those questions. In fact, Nada just simply said, interested, Tim, in the masterclasses and the network. So what we'll do is I will get Tim to put that in the chat box in Zoom, and then I will take it from Zoom and put it to YouTube Live. I have no idea why I've just given you the exact mechanics of how that works, but nevertheless, that's what I've done. So there you are. So what I'm going to do is, before we get started asking those questions, we have got a new section into tonight. So what I'm going to do is open up our PowerPoint presentation. And don't worry, it's not death by PowerPoint. They're not meant to be long in duration, but it's meant to be giving you a bit of a helping hand and something for you to visualize as well. So I'm going to go straight over to that and just drop that to my PowerPoint. Here we go. And the first one will be through myself. So a couple of things that I wanted to bring to your attention is that the self-assessment tax deadline was extended rather, can I say, non-proactive by the government, whereby they said, I think it was last Tuesday that they said they're going to extend the self-assessment tax deadline from the 31st of January to the 28th of February. The downsides to that, which I don't think they made particularly clear, is that you still have to pay your tax bill by the 31st of January. And if you don't, they are going to charge you penalties. But anyone that's sitting there comfortable thinking, well, I've got another month to file my tax return, yes and no. The problem is with that is the fact that you will get these penalties for late payment of tax. They didn't really say that, did they? 31st of March is the key deadline for the stamp duty land tax holiday. As we know, that Rishi Sunak said that there's no stamp duty land tax on purchases of £500,000 or below for residential properties. And there has been calls for that to be extended, but so far, no budging from Rishi. Capital gains tax changes. There's been noise around capital gains tax and whether it will become income tax in the future. Who knows if that's the case? We will let you know as soon as that happens. And finally, IR35. So anyone that's a contractor of any type working as a person for a company providing professional services, you could be caught under IR35, which means that the government wants you to be taxed like an employee, as in you pay income tax and national insurance rather than you having the ability to use a limited company. So that comes into full force on the 6th of April, whereby the government are forcing the company to be responsible for the tax. So you may not have a choice now as a contractor of whether you are deemed an employee, because the employers themselves might tell you you are going to be put on the books. So that's a real downside to that side. I feel like I'm the bringer of real bad news. So with that in mind, let's get on to Bronwyn. Now, Bronwyn's not here tonight, but what she asked me to do is quickly tell you about her book, Building Your Dream Life. Now, Bronwyn is in Africa, Namibia, to do some charitable work, but I believe she's actually going out to see some lions tomorrow. I mean, how about that? How did she get there? Well, you're going to have to read a book, but she wouldn't have got there if it wasn't for property investing. So as the five of us have been left here, not even with a postcard from the lioness, we can be sad, but she is the ambassador of property investing and saying how successful you can be. So make sure you go onto Amazon and read Building Your Dream Life. I've got the book myself. I've read most chapters. I've got to be honest, I'm still reading it. But so that's typically of my job. Oh, there you go. Tim Bishop is beautifully, the handsome devil that he is, promoting that book. Bronwyn's also got a guide, so the website Property Investing Foundation. So if you want to have a look at that, again, the description for this free training course will be on her website, and the website link will be provided in the video description. So go ahead and get that URL to get your free property investment course. Okay, we'll move over to Tim. So Tim, over to you in terms of this chart and what it all means.
Well, first of all, can I say that I'm sure Bronwyn's enjoying herself. She says she's out to see the big cats tomorrow at 5 o'clock. I'm not entirely convinced. She could be lion. Sorry, I do apologise for that. I do apologise. Right. Basically, matter starts. As you would have seen if you've been seeing watching the previous Ask the Property Expert online, every month I give you an update of how many matter starts my law firm has had. And what's interesting is that certainly, as expected, as you can see from the slide, certainly the beginning of the year in March and April, it fell off a cliff. It really did. To give you an idea, we normally were doing about 110 transactions every month. And I think the first 4 weeks we had 3 inquiries. And so unsurprisingly, as you see, it's pretty low in March and April. Then it comes back in June and then comes back with a vengeance and builds up to a peak really in September and October and even November. We got up to, instead of having 110, we were getting more like 170 and 180, massive increase. Unsurprisingly, it then dips back in December. But as you can see, it didn't dip that low. It's below our new average, but our new average, of course, takes into account what happened in August, September, October, November. So in fact, our new average, or the old average, 110, was pretty much what we did in December. And December is normally a very low month indeed. Now, unfortunately, my particular version of this slide, I can't see because I'm actually in the way, which is quite annoying. So see if I can move myself out of the way. Yes, I've managed it. But as you can see, it went back up again in January. Now, for those of you who know, January tends to be quite a quiet month. So the fact we're well above an average, which itself is well above our normal position, is quite unusual. As you can see, it bounced back to the level of October and November. That was really surprising us. Certainly, even within a couple of days of coming back, we'd had a huge number of inquiries. Now, there are reasons for that. I know some law firms aren't taking on work, so I have no doubt that that is causing perhaps an increase in our figures. And I do know that we're gradually increasing our market share. But even so, I think it shows a quite clear tendency for the market to be at still a very high level. Now, what's interesting is talking to agents, they tell me broadly that it's starting to slow down now. And that is not unsurprising. Again, our work tends to come a couple of weeks often after the agents get involved. But nonetheless, it does show that we're still at a remarkably high level when we should have been in a recession, with all the problems we've got. And I know we've got the March deadline coming up, but even so, it never ceases to surprise me. The dip we keep anticipating still hasn't hit us anyway. So that's that. As you can see, quite a substantial uplift on the norm. And Warren Buffett, I love Warren Buffett. You may have heard this quote before. Normally, the last four lines are the ones that are quoted. The be fearful when others are greedy, be greedy when others are fearful. But in fact, the full quote is slightly longer. As you can see, I will tell you how to become rich. Close the doors. Be fearful when others are greedy, be greedy when others are fearful. Now, in case you don't know, Buffett's still one of the wealthiest people in the world. Some of the big software magnates have now overtaken him, the likes of Facebook owners and those kind of guys. But he's still about number 7 in the world, which isn't too bad, really. And the principle of this is what he says: when everyone's rushing, when the market is busy, when everyone is convinced you're making loads of money, that's when you need to be careful. And the opposite, of course, when recession's hit and everyone's a doomsayer, that's when you need to buy. And at the moment, my fear is that at the moment we're at that greedy stage. Everyone is getting really excited. The market is very frothy. You can see from my figures. If you speak to anyone who's involved in auctions, there's plenty of stuff going on in auction, but the prices are high. So I'm not saying whether or not the market will dip. I'm not saying whether or not you shouldn't buy at the moment, but I simply passing on Warren Buffett's advice. And for the sake of that, I'm taking his advice on board. So at the moment, I'm sitting on my hands. I've got a building which I've cleared the debt on, which I will remortgage in due course. So I'm not buying. But do bear in mind what Warren Buffett says. He's not always right, but he hasn't earned the 7th largest fortune in the world by being stupid. He's a very bright man. So there you go. Warren Buffett: be fearful when others are greedy, be greedy when others are fearful. Simon, over to you.
Thank you so much. Before we go on, I'm going to challenge my panel members to equally come up with animal kind of suggestions all the way through. And I love the way that Warren Buffett, especially, he compares the meerkats all the time to make sure he gets the best deal. There you go. That's my penny's worth. So let's move on to NRLA. So Teresa, if you want to take it away, please do.
I'm afraid I won't be able to meet the animal challenge. I'm not as creative as yourself. So I will just talk about the interesting highlights in the private rental sector at the moment. So court cases for possession have been suspended until the 21st of February 2021. So if landlords were pushing through a possession case in the courts, well, as it says, it won't be actioned until the 21st. So you can hear me now. Sorry, did you hear any of what I said? Was I just talking into the wind? Sorry, I don't want to repeat myself, but yeah, so court cases have been suspended until the 21st of February 21. It doesn't mean that landlords can't still seek possessions. If you've got a tenant who's breached the contract or not paying the rent, you can still issue a notice to that tenant. It's just meaning that it's taking a lot longer than normal. And I would just say at the moment, another issue is abandonment of properties. So landlords are thinking, oh, well, you know, my tenant, for example, a student has abandoned the property, hasn't officially surrendered, and the landlord's thinking, well, it's empty, I'm just going to re-let it. But if you do that, you are putting yourself at risk, because you do need to have an official surrender of tenancy in writing, because in the event that you did let your property out and you didn't have an official surrender, the tenant could come back, you know, and claim rights on that property again, saying that you had, you know, illegally evicted them. And also, if the tenant dies, you do still have to get a surrender. So if it's from next of kin, for example, you do have to get an official surrender, or you have to basically take it through the courts. So that was it on possession. So it's not great with possessions at the moment, very lengthy periods, and we're just recommending that you avoid going to the courts, you know, by any means that you can. Also, there is some money out there for properties, which we always like to hear about. So there's a Green Homes grant that you can apply for. It's up and running until March 2022. So that applies to homeowners and landlords. And this is all in line with the government looking to increase the energy efficiency of the properties in the market. So yeah, you can go online to the government website and there's a link there. You can just see if you're eligible, and the vouchers are up to £5,000, which is essentially covering 2/3 of the cost of energy improvements. But it would need to be, you first need to have a primary measure, which is the insulating of the fabric of the building and having maybe changing the heating system. And then you can apply for a secondary measure, which might be just replacing a front door, for example. And if you've got tenants on benefits, certain benefits, you might be able to get the full cost of a grant. I think it's up to £10,000. So I mean, it's not straightforward, because there's a backlog at the moment with contractors, finding contractors who are part of the scheme who can do the work. But it's definitely worth, you know, looking into.
Great stuff. And I heard that there was a backlog, and I think there still continues to be a backlog on there. But the government have extended that Green Homes grant as well, so it just makes it up. And I think there is going to be beyond that as well in March 2022. So there is plenty of time for you to get that done. Thank you ever so much for that. So, skipping about, it's too sensitive here. Simon, take it away if you don't mind. Sorry, you're on mute. Sorry. He's still on mute. Hold on a sec. Simon, you're on mute.
I know what that feels like.
There we go.
Here he is.
It's always great to put forward a really professional view, isn't it? Just like that. Right. Okay. So mortgage market. As we know, 2020 has been a very bumpy year for finance. Pre-lockdown 2020, so January and February of 2020, the cheapest limited company buy-to-let mortgage in the market space was actually 2.64%. And that was with TMW, closely followed by Precise at 2.79. Now that product disappeared through lockdown 1 and has not reappeared until today. Well, actually, at the back end of last week. So we've seen a drop with their Precise's offering on 75% loan to value, 2.79%. It's a 1.5% arrangement fee. So it's still quite a chunky arrangement fee. However, that does close the gap considerably between buying in your own name and buying in a limited company. And I'm all for stirring that debate between myself and Simon and tax and how you should structure your portfolio. Yeah. The other thing they brought down is the 5-year rate, so 3.39. That is close to the most competitive in the market space. However, it does price up very well when you take into account the fees. There's a fixed fee for arrangement on that particular one, which is great. And the other thing they can do is they do a short term to term. So you can take out a bridge product with them, carry out a refurbishment, and remortgage it onto one of these two products at the back end without any overlap. And there are certain products that they can do that with at the moment with no arrangement fees. So it's a pretty great little product. And I think Simon's got the other slide there where we're going to go on to just talk about a couple of other lenders that have kind of followed suit, and then to just again talk about some of the shortages still in the market space. So it's a real yin and yang. So some of the other lenders that have dropped, not by much: Accord 0.01 to 0.1%, Pepper by 0.1%, Land Bay have come back with an 80% loan to value product, which they have not had for a while. But this is the litmus test or the yardstick of lending where I'm at. Okay, so if we were sat here this time last year and we were doing this broadcast, I could have talked to you about 368 different 80% loan to value buy to let products. This time this year there are 74. So whilst the market is still getting back to where it was, it's a long way off. A long way off there. And if we look at owner-occupier mortgages rather than investment mortgages, they're still way off where they were. So 10% deposit, there are a few. 5% deposit, virtually non-existent. So what that means is that first-time buyers can just not get in the market space unless they've got the help of bank and mum and dad. That's me.
Interesting, good stuff. Thank you ever so much, Simon. And we ought to go to Paul Hilliard next. So, Paul, over to you.
Hi, thanks, Simon. Just to confirm that the LMPG offices are open for business. So if you've got any questions or any issues with any of our suppliers, just give the office a call during normal business hours, 9 to 5:30, and we are there to help you. So, but if you can't get through on the phone, because we may or may not be busy, always check us out on the LMPG Facebook group page, because if we're around, or if we're not around, then our members will help answer the queries for you. And the other big thing is we are back doing the lock-in events this Wednesday, starting again this Wednesday. We're live from 6:45 for an hour, and this week we have Johnson Paints colour export, Donna. And she's coming in to explain what you can and can't do as regards colour within your HMOs and properties. So check us out, go on to either the LMPG Facebook group or give me contact me at paul@lmpg.co.uk, and I'll send you a link to that free Zoom meeting. So that's it from us. Oh, sorry. Yeah, LMPG. Not only is LMPG offices open for business, but just to confirm, all of our suppliers are open because they are providing essential products for the UK. So subject to staff availability, then all our branches of our suppliers are open. So but if you can't find one local to you, give us a call and we'll tell you where the nearest local branch is. Back to you, Simon.
Perfect. Thank you ever so much. And for panel members, actually, if you do have events that you wish to communicate out to this wonderful audience, then please feel free to update your slides for next time around, especially for you, Tim, and for Teresa, Apple, and Simon. In fact, all of you. So basically, we need to move on to the questions now. So the first question that is from Brian asked, please tell me about short leases. That's instead of short trousers, so short leases. I'm looking at the flat rate of flat with 96 years remaining of a 125-year lease. What does it cost to increase it? And could this strategy be, what could this be a strategy in its own right? Let's go over to Tim first to get your comments, but also to Simon Hodgson about financing of short leases.
Extending a short lease is not the aardvark you'd think it might be. Is that okay, Simon? No, okay. Yeah, extending short leases. Right. Number one, and as the guy probably knows, if you own a lease with a flat originally granted over 21 years, you have the legal right to force your freeholder to increase the lease by 90 years. Now, there's quite a lot of controversy at the moment because the government have just made some announcements. When I say announcement, there was a big law commission announcement last summer, and it was between the right to manage and franchise rent lease extension. There were 600 or so or more recommendations. The government therefore came out with what was actually a press release earlier this month. Now, people thought it was an announcement, but actually it was a press release. And press release is just government spin, really. And so it was incredibly short on detail. So lots of people are sort of saying, oh, well, what happens, etc. They don't really know, is the answer. The only deadline that was given was with regard to ground rents. There's a suggestion that future ground rents may be capped, and that may be within the next session of Parliament. But we have no idea of the details and no idea of the date for any of the others. However, it does seem highly likely that the government will change the lease extension regulations, and it looks highly likely that for many people that will make it cheaper. So for someone like this particular person who's got 96 years left, I'm going to shoot myself in the foot here by saying you don't need to come to us. I'd actually sit on your hands for a while. The chances are within the next 3 or 4 years, and it could be as long as that, there will be changes, and there's a good chance therefore that your lease extension will be cheaper. Now broadly, you don't really need to worry about extending your lease till it gets below 85, and the critical date is 80 years, because the second it drops below 80 years, the freeholder can charge an additional premium. But that's part of what the government is saying, perhaps that premium will be taken out. So in short, to sum up, for this particular person with 96 years left, I wouldn't worry at the moment. See what happens in the next 3 or 4 years with government announcements, but make sure if things don't change, make sure you think about it when you get down to about 85 years. So put a diary note for say 2032. But apart from that, I think you're on reasonably strong ground. Does that help?
That's perfect. So basically what you're saying is when you get to Paul's age, that's when you should worry. Simon, what's your views on the financing side?
Yeah, indeed, I'd concur with Tim there. With 96 years left on the lease, it's not going to be too difficult. There are some lenders that will want a minimum of 70 years unexpired at the end of the mortgage. So the maximum they're going to give is going to be a 26-year term. But I have got some lenders on my books that will still give a 35-year term to that particular scenario. So, yeah, as it stands, the lease has not got short enough, but it is a great strategy. And Tim's guys there are particularly great at implementing that and activating it and getting it through. I've got a guy who has done 3 of these on the bounce actually since August of last year. He tends to pick them at less than 60 years when they are particularly difficult to do. But yeah, fabulous strategy.
Can I come back on that, Simon? Because I just realised there was part of the question I didn't answer in my enthusiasm to give all that information away. It's whether it can be a strategy. The answer is yes, it can. We've got a number of clients who've been doing exactly that. And the principle is, as Simon said, what you want to do, you want to go for leases that are really low. So 96, 80, it's not the kind of thing that you're going to get a bargain on. But once it drops below, as Simon says, about 60, you're going to have enormous difficulty in actually getting a mortgage. We had one last week inquiring about 15 years. Now, if it's 15 years, there is only going to be the possibility really of a cash buyer. So yes, it can be a very useful strategy, and you can sometimes get extremely cheap properties. But the good thing about this strategy is that it wipes out most of the market. The good thing about legal problems in particular, people tend to run away because they don't understand them. So as a result, normally, if the property is on the market, in theory, every single investor in the country might want to buy it. But suddenly, when you talk about a short lease, most people will run away because they simply don't understand, which goes back to the legal masterclass and the kind of first session we're going to do on things like extending short leases. So it is a strategy well worth looking at. One other tip I would give, if you are looking to do it now, put a nice low offer in. Don't go a little below what you think the price is. If you can find out what the full value would be, and the difference between the full value and the lease extension price, and then knock, say, 20% off. That gives you quite a nice, healthy profit in particular. And what you may find, however, is a lot of vendors don't understand the market, nor sadly do many estate agents. So what you may find is actually the price that the agents put it on for is way above what it's worth. And so you may find actually you have to wait 3 or 6 months before the vendor comes to the horrible conclusion that they're sitting on an absolute duffer and they're going to have to sell it cheap. So if you are going to do this, make sure you work out roughly how much you think you need to buy it for, that 20% below the actual value. And again, I could go into a lot more detail here, but I won't. And then be prepared to put an offer in and go back nicely every so often, because you may find it stays on the market and sticks. And if this person needs to sell, has a need, they're going to have to take a buyer, and it may be you're the only person in the market, which puts you in a very strong situation.
Perfect. Thank you ever so much. And Silas has asked the question, which is the white elephant in the room, isn't it? See what I did there. So Silas asked, which is a typical question of what everyone is asking about, is how should I set myself up from a tax perspective? And the key words that I want to do here is pick out from Silas's message was being a high rate taxpayer, limited company or not, Section 24, and issues around inheritance tax. And it's a big old subject. I mean, when people say, what would you recommend I do? It's like the elevator pitch, tell me how I can save tax. Unfortunately, that elevator answer is never going to be very good. And that's because it doesn't really understand your situation. I'll give you an example, but so I just did a call with someone who set up a limited company already before the tax call took place. They already set up a limited company on a proviso that there was going to be a high rate taxpayer. Two situations arose. Their spouse was a basic rate taxpayer, interesting, and they was looking to give up their job in 3 years' time for retirement. Why do you need a limited company? Well, because I was reading something on Facebook. And on the forum, they said, well, if you're a high rate taxpayer, you ought to be using a limited company. And the acronym FOMO, which is the fear of missing out, plays a real part, really. So you could go to a limited company structure unnecessarily, which is what this couple had done. Fortuitously, they had gone through exchange and we were able to say, keep the property in your own name, which I'm sure with Simon Hodgson would agree with, that mortgage interest rates are lower if you keep properties in your own name versus a limited company. So you always need to be wary of that. Simon Hodgson, we always have this debate about tax, and Tim as well from a legal perspective, but what's your thoughts on what I've just shared with you?
Yeah, absolutely. So as long as it's a simple property, so it's a single let property, or it is a group of small sharers on one tenancy agreement, then the interest rate will be somewhere in the order, and we're borrowing 75% loan to value. The interest rate is going to sit at approximately 1.75 to 1.79, which is a whole 1% less than the cheapest limited company one that I've just talked about. So there's a massive saving in terms of interest rate costs just for doing absolutely nothing other than choosing a different lender. Yeah, why wouldn't you? For sure. Totally.
No, I appreciate that. Sorry, just got one from Sean, and I'm just going to read it out verbatim because I'm just not quite sure I've got my thinking cap on here. So it says here, Sean asked, the wife, that's, or WFE, it could be just my reading here. So WFE, government and major organisations seems to be planning a great reset. It was also in Time magazine in one of their recent issues where nobody will own property but just rent. Not sure if this means that the government buying back property or how this will play out. It may not even come into fruition. Have you ever heard of anything like this? This is quite a bizarre thing. I'm going to go over and slopey shoulders. I'm going to stretch this one out like a giraffe's neck over to Paul Hilliard, then over to Tim. What have you heard, guys?
I'm trying to think of a deaf animal, but sorry, I'm struggling there. A mute animal. Absolute. Oh no, I was going to be rude and say troll. I've never heard anything, certainly for the UK. And I don't think, given that, is it 4.5 million properties that are private rented sector nowadays, something like that? You're looking at a huge chunk of the marketplace. And if there was any legislation to impact that adversely, then, someone's going to have some very, very deep pockets. So nothing I've heard of, no rumours. There's always someone putting stuff about on either Facebook. As they say, advice on Facebook is free, and it's a lot of people say it's worthless. So just be very careful what you read. And again, if you're reading that in foreign newspapers or magazines, then that's it'll be fit for the fish and chip shop tomorrow, as they say. So no, not heard of anything. And I would refer you to Tim Bishop's guidance comment of be fearful when others are greedy, and be greedy when others are fearful. So, if rumours like that are going around, then it may be the time to start thinking about investing. Thank you, Mr. Tim Bishop Buffett, or something like that. So, back to you, Simon.
Tim, I'm just going to ask you, what do you think about what you've just said?
Well, first of all, can I point out that because you obviously are hosting this, you get more opportunities to say things. So I'm not surprised you're getting more animal jokes in. I think your position, therefore, is one of a cheater. Sorry. Right. What about this particular one? I'm a nerd. I'm a self-confessed nerd. I read a lot of stuff. I'm a big fan of The Economist. I'm a big fan of Harvard Business Review. And I've never heard anything remotely like this. I don't think, as far as I can tell, and I'm going to say I'm a solicitor, so I'm not certain, but I've never heard anything remotely like this at all. However, what I would say is I think there are, I'm big on big trends. And I think that doesn't sound like there's any truth in this, but I think there are a couple of trends we do need to watch out for. Number one, in due course, the huge expenditure that the government has made in the last few years will have to be paid back. I know they're very confident they can pay it back with growth, etc., but there's going to be still some significant pain. And they're going to go for easy targets, particularly now the Conservative Party have now moved across to looking for working class seats of the red wall, etc. So I think they're likely to look at easy targets. And one of their easy targets, I'm afraid to say, will be landlords. They see property owners as fat cats. So number one, do expect further tax rises in the future and regulation tightening. We are a target and will undoubtedly be on both the target list of both Conservative and the Labour Party. But secondly, I think there is another underlying trend here. And I think Simon came on to this earlier. Because of a price of houses, particularly with the way that mortgage rates are going now, an increasing number of young people are not able to get on the housing ladder. Now, at the moment, it's not too bad, but that will become more of a pressure. If more and more young people can't get involved, and it's only us oldies who've got it, or people with a bank of mum and dad, you could see significant pressure on government to change that, to allow somehow that there be much less of an us and them situation. Because at the moment, it is an us and them situation. If you own property and your property is going up in value, you're fine, you've got nice low interest rates. But if you can't get on the housing ladder, it's only going to get worse, because as house prices grow and grow higher, you're further and further away. So I think there is scope for governments to do something about that. I think they will take action eventually. What kind of action, I do not know, but I don't think for a moment they're simply going to buy everybody's house back. You would have a revolution. Britain are very much a home-owning class. And although we don't have quite such the level of home owning we had in the 1980s, early 90s, when Mrs. Thatcher's reforms came through, there's still the vast majority of people do own their own homes. I think it's 65% or something. I think if you took their houses away, you would have a revolution. We'd be on the streets with placards. So therefore, I don't think this is a particular concern, but there will be changes.
Can I chip in there? Are you going to say something, Simon?
Go for it, Teresa.
Teresa, if you want to.
Right, yeah. So just taking my NRLA hat off, basically the question about the Great Reset, that is definitely a real scenario. There was a meeting in Davos. Well, it was all online with all the leaders around the world in the last week, and the World Economic Forum have got a plan for a Great Reset. So part of that is that people, will not own property. So that is a long-term goal, that they won't own anything. You'd be renting everything. And I would just say that, it's worth looking into, just to see, what the globalist plan is for the world. But it's also a good idea to look at other streams of information as well, because just because, they're planning something doesn't mean that we have to go along with it. It's a bit like having those oppressive parents, who want you to be a doctor and send you off to university, and you just don't want to do that. So yeah, I would recommend different streams of information. There's one called the Corbett Report, if anybody's heard of that. So just check that out. You can do some more reading. But I mean, as Tim was saying, there would, and Paul, there would be, a complete outcry in the UK for people to lose a property. But when the market's been destabilised, it's rocking the foundations of all those people who aren't set up in business properly. So, if you haven't, had the right education, the right advice from, tax advice, for example, and, mortgage and legal advice, you're going to be on rocky ground. So any disruption in the market, it could knock you off your perch and you could end up losing property. So I would say, just keep tapped into this panel. and just keep getting that advice just to keep your foundation strong. Over to you, Simon.
Sorry, Teresa, I couldn't help but smile because you said perch, and I thought,
Oh God, I did it! I said something.
You know what I mean? Simon Hodgson, over to you.
Well, yes, Teresa. That's a great insight to a completely curveball subject. I'm going to kind of lean on Tim a tiny bit here. The bulk of UK lending is to freehold property. So freehold is that you own the title outright. The lender lends against that title, yeah, and lodges a charge against it. Now, what do you think might happen to a market if everyone is being told that they're going to have to sell, their property's not necessarily going to go up in value, or there are certain properties that they feel have been undervalued and all sorts of it would just create an absolute... I'm gobsmacked, speechless to think that something could be implicated and implemented in that way. Yeah, we're a nation of homeowners. The freehold title, we have one of the cleanest and clearest systems in the world. It's copied the world over, and there's a good reason. It's a great system that works. It's not completely flawless, as I'm sure Tim will concur. However, it it works. Can't see.
I'm going to stay with you because it looks like you're like a rabbit in headlights. There you go, just throwing another one in. So the question was from Mosen. Now, say I was looking at various structures. One of them being what they call I've got to get the name right here. I think it's something to do with like a special vehicle for properties, whereby you're using gross shares and freezer shares. Smart company structure, that was right. Now,
yes.
Interesting enough, I'm going to give you everyone the scenario, okay? So there was a great video done by Mark Alexander and by Ranjan, and they're big YouTubers as well. So do go check out their channel. It's really interesting videos. Ranjan's very much into commercial properties typically, but he talks about good stuff about tax as well. And he talks about this smart company structure, and I'm not going to dismiss what anyone says, because I think you've always got to look at it from on the face of things, how effective they can be. But it's not just looking at their example, it's looking at things that we have always talked about our clients. And again, it goes back to that triangle effect. If we are giving tax planning advice, we always say to people, speak to your mortgage broker and speak to your solicitor before you implement the solution we're talking to you about. And one of the solutions, smart companies, again, this is by Mark Alexander and Ranjan, and it's something we've talked about as well. So I'm not saying it's their stuff, but it's something that is in the round, and it's getting a lot of traction in the marketplace. The thing for me is that a smart company is whereby you've got two parents, and then you add maybe parents, like the grandparents, give them some shares. You've got a limited company that has children with shares as well, and gross shares. Now, Simon, out of 10, if you've got a limited company whereby you've got 8 people involved, 3 kids, 2 parents, and the rest are grandparents, out of 10 lenders, how many will actually entertain that structure? Out of 10 lenders, give me the number.
If you've given all of those 8 people equal shareholding, then you've almost reduced that number down to 0, because no one has a majority shareholding. So therefore, the lender's got to underwrite all 8 people, which they're not going to do. It's just not going to happen. So but
the popular scenario. So the popular scenario is whereby the mum and dad has 99%, but they've got all these then other shares. So the other shareholders are only 1%, but there's 8 people in that list.
Okay. It is possible to pick certain lenders that will only want to use the majority shareholders and ignore the minority shareholders. But it gets more and more difficult the more and more complicated you make the structure. So if you imagine lenders, the cheapest lenders in the market space have the most automated systems and have their underwriters carry out the least amount of tasks to get that money out the door. If you imagine that the most simplest form is an SPV, it's just been set up. It has either 1 or 2 directors. There are also shareholders. It's a tick box exercise, and literally it can go along the conveyor belt and out it goes. As you layer up your smart company structure, it's still possible to do, but it then goes out of the realms of the cheapest lenders in the market space. So what's known the challenger banks. The challenger banks will do just those things. That they will do things that the cheaper banks won't. However, it's more labor intensive. The underwriter has to spend more time on the case, so therefore the product becomes more expensive, and there's less competition for that lender. And so it goes up. So there's a real balancing act. And again, if you're doing simple purchases, if it's single buy-to-lets, and potentially, as you've kind of alluded to, Simon, they might be retiring in the future, you could be comparing an interest rate of 1.79 with an interest rate of 4.5 to 4.75. That's an absolutely colossal difference. It's more than double. So the tax advice would have to save an awful lot of tax in order for that to work. It has to be bespoke for everybody, for every particular scenario and situation, where your goals are, what you're looking to do. It has to involve Tim, Simon, or in your power circle, those three members. Yeah, because there is no one shoe for everybody. Really isn't.
I'm glad you said that, and we'll probably leave that point there. But to conclude the matter, I do think that you can be very tax efficient and not have finance in place, or you'd be tax efficient but you're paying through the nose in finance charges. And it's really a balance between the two. For most people I speak to, whenever I say, well, this is going to cost you 2%, 3% more in buy-to-let finance, they then start to say, well, actually, this smart company is not worth what it's written on. I kind of think it is, but you've got to do it in the right environment, as in you've got to be in a position whereby you don't need to rely on the banks to be tax efficient. I think there is such a huge playoff, and it can be quite difficult. We have, I would say, 4 out of 10 of clients that come back because we've set up a smart company structure for them. So we do it for clients. So, anyone doing this kind of thing, it is tax efficient. But we have 4 clients come back out of 10 because they want cheaper finance in place, and then we have to redo all of the work we put in. And it takes time, and it takes more effort, and there's a lot more cost associated with redoing a company as it is to set one up.
Can I make one last comment, Simon? And I'm in no way criticizing any of the people out there around Jan or who are suggesting these structures are great things to do, because I know Ranjan wouldn't, for sure, but there are other people out there that are promoting types of really complicated structures. Guess which lender pays me the most amount of money? The one with the most complicated tax structure with the highest interest rate. So I could be paid up to 3 times as much money for writing that kind of mortgage case, which is nice, don't get me wrong. However, you have to treat the customer correctly and look after them and give them the best possible advice and product. And if that is the one that provides the least amount of compensation to me, that is the correct product for the client. Yeah. But I am worried that some of that advice out there potentially it is high and heavy on tax planning costs, high and heavy on finance costs, and might not have the person's best interest at heart.
Can I also come in on that? Anything involving so many people can get extremely complex. Yeah. So in Simon's example, I think he said, well, say there are 8 people involved and they've each got equal shareholding. Well, how are you going to run the company? You're going to have some quite decent assets to make it worthwhile dividing by 8. And therefore, you've got to be very careful in the shareholders agreement who has control. And it may be that some of the people don't like the idea of having no control over their own money because there's going to be substantial cash in there. Alternatively, if you have 8 people trying to make decisions, that's going to be a disaster. I'm a great believer in the fact that the company is just a horse designed by a committee. And with 8 people, for example, in that scenario, trying to make decisions, I dread to think. All I would say is I see considerable scope for massive litigation costs. So bring it on.
Yeah, I think just to clarify though, guys, I do think that the smart companies have got to a place, they really do have the right place if it's done in the right context. I think you can control those certain things by giving shareholders. So mum and dad typically would have 99%. So the control is always there. The shareholding itself can be non-voting rights for the kids and the parents. So there's no comeback from that side. So I think, but it is back to Tim's point. You do need to structure it in the right way. I've seen some people who take the advice from YouTube channels such as Ranjan's video and almost try and do it themselves. And it's like, whoa, you're coming to us then with this hodgepodge kind of limited company and saying, I did it for like $12.99. Can we have to go with it? And it's all full of ordinary shares, equal shareholding. It's like, no. This is a total mess and you have to redo it. But we'll leave that for another day. I think it's...
Can I just come in, Simon?
Sure.
Some advice you gave me a long time ago was never let the tax tail wag the investing dog. I hope you like the animal reference there.
Oh,
but yeah, don't do it just for the sake of tax, because the HMRC will come after you. So that's my
thanks for that. No, it's good. I've got to be honest, you're outfoxed me on that one. So let's talk about Stuart, YouTube Live. So let's get to the core of the questions. I've answered a couple of questions on the people that have already registered previously. I'm going to go to the YouTube Live ones now and just run through those quickly. Stuart has asked the questions, why do professional landlords find it so hard to remortgage portfolios? I think Simon's alluded to it. The fact that there's less mortgage lenders out there always makes it difficult. And it does depend on the situation in regards to risk. So I shan't go into that too much. I think that's been done really. Nada's asked about interested in Tim's masterclasses on the network. So Tim, again, if you could put that into the chat box of Zoom in terms of the link for the event plus the date, I will copy and paste that into YouTube Live for you so everyone can go onto that. Because Dronfield Holdings, again, interested in the online networking, Tim. Hopefully you've had enough pressure now to get it done. Vincenzo is asked a question. Hi, Tim. I'm also interested in networking law masterclasses. Come on, Tim. Let's get this thing going. Silas has asked a question. Interested in the legal masterclass? And by the way, I'm not lying. These are all in line in terms of the questions that's going through. So people are really wanting to see this. So that's good to see. Sami Sang has asked, could mean a void period to get a tenancy to be surrendered? Yes, Sammy, I think that would be answering that. If you need to wait for a tenancy, you will get void periods. Is the Green Homes grant available in Wales? Sophie asked that question. Teresa, is the Green Home deal nationwide or is it just to England, do you know?
It's just England, yeah, I'm afraid, yeah.
So Sophie, you're going to have to move to England. That answer's sorted out. So I'm always pleased that I can give such a practical solution to things. Ned has asked a question. Everyone, how would you fund a purchase based on the uplifting value, which has been refurbed during a delayed completion? Buy-to-let lenders only lend for what's payable to the vendor, not the new value. Simon, over to you.
Right. I will disagree with that statement. Buy-to-let lenders will not just lend on the purchase price, but there are very few lenders that will lend on the open market value in that set of scenarios. It will come down to the property, where it is, how much has been spent, where that money was borrowed to do the works, and also the amount of properties that the borrower currently owns. So they'll need to own a minimum of 2 buy-to-lets for the last 12 months, qualify as an experienced landlord and investor. Okay, and then it is possible to go straight in with a mortgage off the open market value of the increased price. Now, I've got this going on right this moment, utilizing the strategy that Tim was talking about, short leases, where someone has negotiated a lease extension on a flat that had 50 years, an additional 90 years, paid the lease consideration. They actually bought the flat cash. No, sorry, that was another one that they did. It's got 3 on the go. This particular one is a value of 160. 75% of that's 120, and the purchase price of the flat is 98 plus the lease extension cost of 23. So all in for 121, and the loan is for 120,000. £1,000 short of costs to complete. So it's doable, but hard work.
Excellent. Good. Let's move on because there's plenty of questions on there. So Liz Kalu said, Simon M, can't hear Simon H very well. Can you turn up the volume on Simon H? To be honest, he's got a small voice box, so bless him. He's only 2 so he can't, he's yelling actually. So
Are you calling me a mouse?
No, absolutely not.
Oh,
no.
I've got my animal reference in. Thank you.
Yeah, he's got one in. He's certainly got one in. Silas has asked the question, can you buy a property and let it to your family under a buy-to-let scheme? Oof, back to you, Simon.
No.
Short answer, no. Ben has asked on YouTube Live. So if you've got a question, make sure you get your question YouTube Live and we'll be sure to answer it if I like it. Ben has asked a question. Simon H, can I get the Simon Hodgson show? I mean, Tim, Paul, Teresa, let's just bugger off and leave Simon through it, shall we? So Simon H, can I get lending where the lender will take a charge on residents without releasing equity to use as a deposit on a buy-to-let purchase? Aim is to refurb the buy-to-let and release equity to repay charge.
Yes, indeed you can. It's not every lender's cup of tea because it's a regulated bridging lend, but there are lenders out there who will definitely do it for sure.
Good-o. And I've just seen that Tim has now finally provided me with a link. So I'm going to copy and paste this to YouTube. So anyone listening, YouTube Live, you will see this coming onto your screens in 2 minutes. So I'm just going to put that straight into there. There you go, guys. If you can confirm that you've got that, that would be perfect. In fact, I can only do 200 characters. What a ridiculous thing. So I shall just put in the main subject then, online property meetings every second and fourth Wednesday. There you go, whack. It's not a whack-a-mole, but it is certainly a whack. So let's get to the next question on the YouTube Live, and then I'll go into my in fact, there's a question that was come through, and it's from Dean. And it talks about loaning money from one limited company to another. And I don't have any issues from it from a tax perspective. If you've got a company that's making money, and that could be typically whereby you're selling professional services, and it's got a cash pot pile, could you lend that money over to another buy-to-let company, as an example? The answer is yes from my side of things. But you know what, Simon Hodgson, I've never thought about it from a financing perspective, because if you've got a company that's trade, it's very profitable, but it takes money for the deposit of a buy-to-let property. Can that do it if it's not connected, by the way? It's a totally separate company.
Yeah. Yes, you can do it, but it falls back to the earlier topic of the cheapest interest rates in the market space, so your precises and what have you, and your tier 2 challenger banks. You'd have to go to a tier 2 challenger bank that has the capacity to underwrite that. Standard stuff will only lend to SPV, very standard straight setup. You can have direct loans to form deposits, and that's pretty much it. If you want to do intercompany loans, it then needs to go to tier 2 banking. Right. Doable, but just cost you a bit more money.
I want to continue with that because Dean's asked a very good question about joint ventures, and it's related because I think what will happen is that you'll find more and more joint venture partners using limited companies to mitigate against risk. What will happen is that potentially you've got a similar situation whereby you've got JV partners that have got limited companies doing trade stuff, and then using those finances into a joint venture deal. Now, that joint venture deal could be in personal names, and I'll be interested in Tim's view after I come from you there, Simon. So Tim, the question will be, should a joint venture, A, be investing together? That's a good question. And I'll come to Paul on the final one of this, so hang fire. But there's the legalities around joint ventures. Should it be done in personal names? Should it be done in a limited company? What kind of risks are involved in a joint venture? But initially, Simon, to you, what issues can you see when joint venture partners, whichever way they structure it, put money together and then are financially, they're tied together? What about financing? What about risk? Simon, over to you.
Right, okay. I guess the first and number one thing is that as soon as you do that, you're creating a financial association between yourself and these other people. That's not necessarily a bad thing as long as things are going okay. So you'll need to check out, first of all, who they are, their track record, their credit profile, etc. If they've already got mortgages, all the better, because they have an awful lot more to lose if things go wrong, and that, you know, in that fashion. But also it proves that they are adept at maintaining financial positions with lending institutions. In terms of risk, yes, an SPV definitely is a limited liability type structure. So therefore, you will put the deposit monies in, typically 25%, and the lender will almost certainly ask you for personal guarantees, which will generally run to 20%. So you are typically risking 45% of the value of the property, as opposed to borrowing in your own names, where you're 100% responsible for all of the debt. So, but hey, you know, property is definitely something that you buy to grow, and you know, you should never be buying it, looking at it, going wrong. However, you're winding up a joint venture, I believe, is an awful lot easier within a limited company, because quite often one of the partnership wants to maintain the ownership of the property. So it's not that difficult to buy out the other partner as shares and transfer as shares across and pay stamp duty if it's necessary in that structure.
Tim, over to you then. What about the legal side of two joint venture partners getting into business together?
Before I mention that, briefly, just in terms, I'm really positive. I'm not fishing for compliments here, but I'm really pleased to see the response to the legal masterclasses. I don't want to crow about it, but clearly people are raving about it already. That's 3. Right, back to your question, joint ventures. Broadly, what people need to know is that if they go into business with someone, there are 3 structures they can use. Either, obviously, if they're on their own, but if they're with someone else, either it's a partnership, a limited liability partnership, or a limited company. Now, the critical thing about partnerships is that you don't have to have anything in writing to actually set up a partnership. And this is what some people don't realize, that as soon as they go into business with someone, if they haven't actually formed either an LLP or a limited company, they are in partnership. And it's critical, therefore, the 2 stages are, first of all, due diligence. And it's remarkable how many people don't do due diligence. They think they know someone. One of the masterclasses will be about joint ventures and due diligence, and there will be a due diligence checklist as part of that. And I don't know anyone else who's produced it, but due diligence is absolutely essential, because I'm afraid to say people do lie about their background, and there are some truly shocking examples where people claim to have property, claim to have qualifications, and they don't. So that's number 1, and you've got to trust the person. And again, that's a critical thing. You need to know all about them. And if you do go into a business with them, then it's really, really important that you get things set out in writing, whether it's a partnership or a limited company, and don't just rely on someone else's legal documentation. With a partnership, you need a partnership agreement, and it needs to be built around your particular circumstances, and exactly the same with a limited company in terms of the articles of association, and in particular, a shareholders agreement. You need to set out exactly what people's responsibilities are, who can do what the shares are, etc. And things like, for example, if there's a deadlock, if you have 2 of you, how's that resolved? You need to have a system in there to resolve a deadlock. There are a whole load of issues there, but it's very important not just cobble together something, but to actually get a properly drafted shareholders agreement or partnership agreement by a solicitor. On that point, would it help, Simon, if I did a link to our website with the page on shareholders agreements and partnership agreements? Because they each they're both really long pages, and they've each got great long sections on the kind of things you need to think about if you've got a shareholders agreement. Say the 30 questions you need to ask, that kind of stuff. Would that help?
That would be a great battle out of hell.
I should do that now.
Perfect. Paul, give me your story about the nightmares of working with joint venture partners and some positive ones as well.
I'm pleased to say that the vast majority of my experiences are good, but always beware of the snake in the grass. Yeah. If you want to do some research, due diligence, there's a very good Facebook group called Property Sharks, who will generally name and shame people who are being very naughty. So always keep an eye on that. I would hasten to add that when I first started, there were quite a few back in the early 2000s, or late 2000s rather, gurus. There was one guy in particular who was buying up every property educator and property business going, who ended up in court and in jail. And so just be careful. Even if they're a guru, do not take them for face value. Always do your research. And in fact, I know of a current guy who's got a very good reputation, who is promoting a developer who is a complete rogue, and a lot of people have lost a lot of money. So even if it's referred by someone you know and trust, always check whoever you're dealing with, check them out. The one thing I would add to Tim's list was deed of trust. I've done a lot of JVs, and I've always had a deed of trust because of the implications of financial association, shall we say. So always be careful. And by doing it by a deed of trust, if anything does subsequently happen to any of your business partners, then there's no linked financial association, and your credit rating should not be affected by them. Whereas if you go into a partnership, then what the heck, anything can happen. So just be careful. So as I say, beware of the snake in the grass, and I always think, having said that, if you're going to go into developments, then SPVs are, with a limited company SPV, perfect example of that's the way to go. And as Simon Hodgson pointed out, it's a way of limiting your liability and getting some sort of protection there. So back to you, Simon.
Yeah, I think the analogy or the pointing to the Facebook group, the Property Sharks, was good in two things. One, it's a useful website, I'm sure, but the sharks analogy was brilliant. I'm sure that group is there to make sure that there's always the bare truth. But that said, we need to move on. So Zamin has asked a question about directors' loans. So there's another question about directors' loans. And in this particular situation, they're saying, can I use the money for whatever I want? The answer is yes. If you loan money to limited companies, by the way, two things can happen. You can charge the limited company an interest rate, which if you do it right, you can receive as a basic rate taxpayer £1,000 worth of interest tax-free from your limited company. So that's always a good one. If you're a high rate taxpayer, it's reduced to £500. Now, if you have a loan to loan arrangement, again, you can charge the company that's taking the loan from the other company a loan interest as well. So do bear that in mind when you're going through it. As Zabin said, something funny enough, interesting enough, from Simon Zucchi's Property Magic course, talking about, and I've done Mastermind myself, in terms of the salaries out of a limited company, it talks about, we talk about, take a salary of 8788 because that's below the national insurance level for an employee and employer, and then you top it up to dividends, and you can do that all the way up to 14,500, which is all tax free. And there is a challenge here to say, well, actually, your employment allowance on national insurance is £4,000, so why wouldn't you just pay up to 12,500? And the simple answer is employee national insurance. Yes, it does away with employer's national insurance, but actually, you do have to look at the small print of your employee national insurance as well. So that's why we cap it at certain levels. So I won't go into too much more tax stuff, but I did see a question through from Zamin. I may as well answer it. I wonder what help can landlords get? I would say just look out for on the websites. There are things like the bounce back loans. There is this self-employment income support scheme, but you have to be self-employed. Property investors, as much as we want to be called self-employed, we are not. We are property investors, therefore you can't get a self-employment income support group. And the furlough scheme as well. You can do furlough, but on yourself. But I think that's quite a risky thing to do because technically speaking, if you are an owner of a business and you've got property, you are going to manage those properties. So how can you furlough yourself? I have seen that happen quite a few times. I don't think it's the right thing to do. And equally, if you've got employees in your business, again, how can you really furlough yourself? I have seen that a couple of times as well. What I'm going to do is just quickly go over to the questions because I've seen a lot of people badgering Tim for that masterclass. I'm so pleased that he has not put his head in the neck in the sand like an ostrich and delivered the result for you. So I'm pretty pleased like that. So I've got a couple more questions that's come out. Palm Golf IP has just said, just to confirm, the void of ground rent hasn't come into effect yet. It's just a suggestion. If so, how will it affect current owners? Teresa, can I give that one to you?
I am clueless on that one.
Okay. Anyone else that can talk about that ground rent? So I'll just repeat.
I think, again, this all refers to the government press release on the first week or two of January. If I remember rightly, I have to double check the wording. I think they said the cap on ground rents would be introduced in the next parliamentary session, a cap on ground rents. And that's about all they said. So it's very, very, so the implication is that that would be for new ground rents. How they deal with ground rents on old properties, I'm not entirely sure. The problem is the kind of announcement they made was so vague. They said, for example, bullet point, will save leaseholders tens of thousands of pounds. Don't really say how. They don't want getting rid of marriage value. There are all sorts of queries. We simply don't know is the answer. But certainly the suggestion is that there will be a cap on ground rents introduced in the next parliamentary session. How it affects existing ground rents, I'm afraid we'll have to see.
Tim, just keeping on with you, actually, one of the questions that David Baxter has asked is, can you give us the pitfalls of tenants in common? So for listeners out there, there are two legal structures that you can own a property. There is the joint tenants, which means that basically you own the property 50-50 between you and your spouse and civil partners. And then tenants in common, where you have a disproportionate share. And the reason why you might have a tenants in common rather than joint tenants is because one person might be a high rate taxpayer, so you give them 1% of the beneficiary interest of the property, and then the basic rate taxpayer or no taxpayer, 99% of the beneficiary interest. But Tim, what are the pitfalls of creating such a document?
I cannot, it's one of the, there's always something in life that you always forget. And this is always the one that I always forget, and I always have to ask someone. What I'm going to do, there's a page on our website all about the difference in tenancy in common and joint tenants. I don't know why. I have my own little black spot about this, and I always forget. So I'm simply going to bottle the question, and I'm going to go and put the link on the chat.
What I'm going to do then, just to bail us both out, because I haven't heard the question.
I can never remember.
Don't worry, I'm going to ask Paul and Simon a question. So Paul first. What can you tell us about furnished holiday lets? Is that the strategy going forwards?
Are you talking UK or European?
Oh, both. If you're good to both.
One of the strategies everyone's talking about for this year is obviously service accommodation, furnished holiday lets in the UK, as unless we're going to be very lucky and get everyone jabbed, then we're not going to be going away. Because if you've got to then take 2 weeks further holiday to self-isolate in a plush hotel at horrific rates, then you're not going to go. So you're going to stay at home. So if you're going to stay at home, look at investing in the holiday lets around the coasts of England and Wales. Certainly, I would suggest England, because Wales is a different legal entity as regards. You've got to be a registered landlord, I believe. So I can only talk in respect of England, and I would suggest, if you've got the money, you've got the do the research and see what you can get on a suitable location, and check out what you can rent it for. And if it ticks the boxes, then speak to Simon Hodgson and get a service accommodation mortgage. But if you're looking at abroad, then, as I said earlier, everyone's going to be, I think, staying at home this year, and therefore, keep your hands in your pockets and invest in this country for the short term.
Just before Simon kicks in, kicks in like a donkey. Even our YouTube live guys are kicking in with this as well. So Sophie's just put ha and then picture of a lion, which I think is fantastic. And then I've just seen someone else who's just put in here. Someone's talking about, we've got pandarized because we are doing so much work on the forum. So thank you ever so much for that. That's just really entertaining. The fact that you're all joining in. So more the merrier, please. That'd be fantastic. So without further ado, let's go back to you, Simon.
Are those guys fishing for compliments?
I think they might be.
So the holiday let, so service accommodation question is a really great question. However, I would link that back into one of the first things that I learned about property investing and continue to use up until this day is that every investment that you have should have more than one avenue. So if you're looking at holiday lets, you need to make sure that it has a strong residual rental background and demand for the normal user market, so that if you can't get that higher additional rent, you can fall back to doing normal rents. And in holiday destinations, seaside destinations, location, location, location. So at the moment, any property in any half decent seaside resort is going to be well subscribed to for the next 12 to 24 months. However, I'm not entirely sure that after that 12 to 24 months has gone and potentially the vaccination program has worked and we've got through various different strains going around the world that might also be able to penetrate the vaccination program, that all of those people who like sunshine and like different destinations, and the UK is a great destination, however, you can't guarantee the weather. We're going to see a mass exodus to people going holiday abroad again. And you know, the holiday abroad will be an expensive item, I believe. Yeah, airlines will be looking to recoup losses, etc., etc. And if you've bought a holiday property in a fringe location that you didn't do your proper research on, you will find that your voids at that point will be horrendous. And the profits that you thought you were going to get aren't necessarily going to materialize. So be very, very careful where you do it, where you buy it. And if you can, yeah, that residual fallback rent and or the ability to let it out Monday to Friday to key workers or workers who will continue to require to stay away from home long after the pandemic has disappeared. Just be careful where you buy is what I would say.
Perfect answers. Thank you so much for that. People are asking on YouTube Live, just continue the debate about smart companies. And one of the Des has asked about, what about parents holding shares on behalf of children via declaration of trust? And I also saw someone saying, Sammy said, be smart companies, do you mean hybrid structures? There are many, many variations of this thing. It's almost like taking a wheel of a bicycle and wrapping it around, and all the spokes within that wheel are different strategies that you can put through. It doesn't help when you've got different marketing terms as well for limited companies when you talk about shares, whether it's growth shares, freezer shares, ABC shares, alphabet shares. There's so many things that can confuse you. I kind of think it goes back to my point of these forums are fantastic, but you do need to understand if it's right for you. So this forum is never going to answer the answer, is this what I should be doing? You need bespoke advice on each one that you're doing. I am doing some videos, funny enough, with Mark Alexander and with Ranjan, because we've obviously been looking at each other's YouTube videos. And I look forward to kind of getting on and finding out the pros and cons of each structure. I've actually done an interview with Cotswold Barristers and with Mark Alexander. And that video, I believe, is going to be scheduled for this week. It's actually been scheduled, so you should be able to see it on our YouTube video already. So press the reminder, get the notification, because we do talk about that and we give about 4 or 5 different scenarios of smart companies. So that's an hour long, I think. So it is worth watching that video. So that will be on there. So just going on to the question. So hi, Tim. So Tim, bringing you back. RE a PD scheme. If we have a scheme we are wanting to change to increase the number of units, does this have to go through planning, or does it have to be done prior to changes in March? Tim, over to you.
Well, I'm going to answer that one question and not answer another. To be honest, that one is very simple. I don't know. One thing I'm not a planning lawyer, and we are not planners. Anything when it comes to planning, I would always go to a specialist town planner. So the answer is that that's the first thing I would do. We don't have a town planner on our panel, but that's a question for them. I would never dabble with planning law apart from the very basics, so I don't know the answer. However, I can come back to the other one, which I bottled out earlier on, which I've now reminded myself, which I always know this, but I can never, I just get confused. Very simply, joint tenants, tenancy in common. I put a couple of links on the chat, but in essence, joint tenants own property equally. So in other words, you own the entire property and you own half of it each. Tenancy in common, you own separate shares. And the significant thing about that is if for any reason you should die or divorce or whatever, you can pass your separate share of the property to someone else. So for example, and I know we've had this example before, if Simon and I are married, for example, of course we can be now, and everything's hunky-dory, we might want to hold the property in joint tenants, a joint tenancy together, but then if I or he should predecease the other, it will go to our beloved partner in full. So Simon would own the whole thing if I pop the clogs. On the other hand, if Simon and I have a big tiff and we fall out and we decide we'd never want to see each other ever again and we split up, in that particular case, I would say you would immediately want to split to a tenancy in common, because in the meantime, if one of us should die, we probably wouldn't want our share to go to the other. We probably wanted to go to somewhere else, friends, family, children, whatever, and that would be a tenancy in common. That's probably the very simplest difference between the two, whether you want your property to go to the other person, whether you want to own it equally, or whether you want separate shares. And Simon, I'm not going to propose. I'm already married. Sorry, Simon, you're 30 years too late.
Can I just say as well, Simon Hodgson, before you get excited, he was clearly talking about me, sir. So, you know, you just wind your neck in, if you don't mind. So moving on from that, so thank you ever so much for that. I've got some links into the chat box. So please, 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 if you haven't seen those links, make sure that you get those. I've just got one more link to put into the YouTube live because I forgot to do that. So sorry guys, but I've put that in there for you now. So that should be all in the links for you. So that's all there. So please do confirm you have that, one of you, just so they can see the links. Keeping on that subject, obviously we've been cooped up together. Not you and me, I'm not continuing that theme, but in terms of, you know, husbands, wives, civil partners, and there are breakups. When it comes to divorce, and interesting enough, one of our articles talks about capital gains tax and divorce, and that's had a huge spike in recent weeks, which is quite unheard of. But in divorce, if you've got a property, and I always get this question, it's always a bit awkward when you have a tax consultation and one of the partners, you can see on the video screen, he's got a question, but they know full well they can't answer it, ask it out. And that question is, what happens if we get divorced? So they don't want to say that, but they are, one of them is always thinking about it. And interesting enough, if they get divorced, it doesn't, for me, it doesn't matter if you've got this tenants in common or beneficiary interest being assigned from one person to another at 99% and 1%, does it, Tim? Because if you go to court, it's a free-for-all, isn't it, in terms of what the judge decides?
Broadly, you're right. Overall, when you get divorced, and the court will, although often it's done in negotiation, but the law says broadly, everything gets put into the pot and gets divided. Now, the issue really, there are a number of issues. One, for example, is how long you're married. So I've actually had one client many years ago who I think was married for about a week before she tried to get divorced. And in fact, I think she actually succeeded because she was drunk, she was cajoled into it, and they never consummated the marriage. But that's not normal. Normally, a short marriage is at least a year. And therefore, it was a short marriage. You often would come out of it what you put into it. However, if, for example, Simon and I had a long-term relationship, say our 30 years, and we'd been together and we'd adopted children, that would be very different indeed. You probably start off with a starting position of a 50-50 split. So yes, in theory, everything is up for grabs. But all I would say is sometimes if you don't necessarily want automatically a share to go to the other party, it is worth thinking of tenancy in common. It's something I know our divorce solicitors often recommend when people are going through the process of divorce, because it's not automatic that property will be split, and you may want to actually safeguard the position and actually choose where it goes. So it's a combination, yes. One other thing, can I just mention, it's interesting. The current situation with lockdown is a bit like a cross between a recession and a holiday, because what we've noticed is in the past, the spike for, and this is not just us, this is solicitors generally, the spike for divorce usually occurs after holidays, after summer holidays and after Christmas holidays. September and January are always peak periods for divorce. And that's because people are forced together. So that's a bit like lockdown. And recession is quite different again. What we've found in previous recessions is that lots of people get worried about finances and talk to us, but actually a surprisingly lower percentage actually go ahead with divorce because they're nervous about what happens with finances. So at the moment, we're seeing a lot more inquiries that aren't converting into divorce, but we think they will down the line. But the important thing to say there, if you are in a situation of a relationship breakdown, or you're not sure what your options are, don't suffer in silence. We and other solicitors as well often offer free advice. We offer first 30 minutes, and we do it by Zoom at the moment, no commitment. So if you're thinking but actually nervous, do come to us. We'll talk to you, put your mind at rest, so at least you know what your options are, even if you don't want to do anything now.
And just to finalize on that point is, if you are getting separated, don't move house unless you've sorted out your assets, because capital gains tax can be triggered once you leave the house, not when you are divorced. So just if anyone's doing that, because I've just had a massive issue with a CGT bill that wasn't expected from one of our clients when they left the home 3 years ago. And that was on their home. So it can be a real big mistake if you're not planning things correctly. Listen, guys.
One last thing, on that very quickly, 10 seconds. Simply, yes, if you are thinking of splitting up, don't just move out. Always speak to a solicitor first, because even if there is a proper division of the family assets and everything is in the pot together, including pensions, tactically moving out sometimes can put you in a weaker position, because if one party stays in the house, they've got sometimes a stronger share to stay there. Thank you.
So rule of thumb, lock your spouse out first. Okay, so guys, thank you ever so much for joining us this evening. I appreciate that. So we've got through the majority of questions. Look, I saw some questions that was asking quite specific stuff about lending and legal stuff. Please reach out to the people that's on this panel members. All the links are below this video, so please do that. The next session that we're going to be launching is again Monday, the 1st of March, so which is 4 weeks away. Bronwyn should be back to rescue us from this shambles of this animal calling, which is just crazy that we act in this behavior. She will put us back in our place. But until next time around, guys, and for my panel members, please stay online, Simon Hodgson. But for the rest of us, thank you ever so much for joining us, and we'll see you all again in 4 weeks' time. Everyone, goodbye.
Bye.
Okay, I think we just ended that. So let me